All right, folks, it's another week. We are back at it. This is What the F Happened, the show where we rant, we rave, and we will argue about what's going on in the economy, the markets, and all around what's happening with money. And I'm joined here with my partner in crime, Mr. Snaggy, who's down in Florida. I guess one of the topics we'll be talking about is hurricanes because it's in the news. But we're also going to be hitting on the misses that just happened today, which are going to probably drive the markets lower. We've been talking about it, but the unemployment numbers or the new job creation numbers, as well as the GDP growth, those are going to be the topics for today's show. So get ready, pop your popcorn, grab your coffee or whatever it is you need, because today is going to be action-packed. We will see you back in just a second. All right, we are back at it. It's another week, which means it's another What the F Happened. And we're going to be talking about a lot of what the F's today because the news has been hot and heavy. Everything from political, things heightening to Eminem telling one of the Republican nominees that they can't pretend to be Eminem and they can't use Eminem's songs, all the way to GDP numbers and the revised growth being lower than expected, and new job creation missed in a huge way. So those are going to be some of the main topics because this is stuff we've been talking about. But Stephen, I'm going to open up with an economic report that I just read this morning, and it actually has to do with federal tax receipts. So when you think of federal tax receipts, that's the money the government takes in and taxes. So if you are in a booming economy and you have GDP rising and everybody's doing well, Stephen, what would you think would happen to tax receipts for the federal government?
You think that they would be more?
I mean, if everything's going good, right? Wouldn't everybody agree? If things are going great, the government would be collecting more in taxes. So get a load of this. The federal tax receipts are crashing, which typically is a sign that we're in a recession, but nobody's calling this a recession yet. Economists are, but then they're saying, no, well, we don't know. And the government, the folks down in DC are just changing the rules of what a recession actually is. But here we go. So I'm just going to read this. This is a chart that I got from one of the economists we follow. The chart shows the federal tax receipts are crashing again, which normally would be a sign that we're already in a recession. And when you actually look at these receipts, when he says crashing, they really are. I mean, you can kind of see over here, this is where we were. And look at that. It's just plummeting. And if any of you guys can see this, I'm talking about this one right here. So it goes on to then say tax revenues have crashed more in each successive recession since 1970, when they fell about 3% in the 70s. Revenues were down 7% in the 80s. That was a downturn, another recessionary downturn in 1980 to 82. And then 14% they were down in the 2001 recession, the dot-com crash, and 18% down in the 2008 financial crisis. So what this economist is saying is, because of what he's seen in the past and what he's seeing right now, he expects tax receipts to go down roughly between 25 and 30%, which might be aggressive. Okay, but that's what he's forecasting. And he's also forecasting that we are long overdue for the next recession, which by the numbers, recessionary periods follow the short-term debt cycles 5 to 7 years. We are long past the short term. So we are approaching the long-term debt cycle, which will be a doozy. And here's what he's saying. Now, you could take this for whatever it's worth. It's just an economist. But he is saying that, I've been forecasting for a long time now that this next recession would be about 50% worse than 2008 and 2009, with around an 86% crash on the S&P 500 and a 15 to 16% decline, or 15 to 16% unemployment rate. So just think about that. He says we're already in a recession, but the numbers are not reflecting that. He said all the signs of a recession were there, but the numbers don't reflect that. So then he goes on to, and I'm not going to bore you, he goes on to say, do you really believe the numbers, or are they going to be revised? He said, we have suddenly gone from the most aggressive stimulus in history in March of 2022 to the most aggressive tightening ever. The Fed has tightened by raising interest rates 525 basis points. And Jerome Powell just came on, Stephen, and said they're going to raise them probably another 0.25%. Like, he didn't exactly say that, but he hinted that the inflation is still growing too fast. Their target is 2%, which, you know, I guess that argues the point of where did they come up with this 2% number? Stephen, do you know? Like, where did the Fed come up with 2% as the number for inflation that we got to hit? Because that's their target.
It's pretty wild that, I mean, that's kind of their goal. I mean, the whole central banking cabal is just insane. But I mean, if you think about what 2% inflation really means, it means that your money in 50 years is going to be worth 100% less than what it is today in a mere 50 years, which, how is that a good thing? I've never really understood that either, Chris.
Yeah, I don't know. I beg to ask anyone in the audience, anyone from TikTok, Instagram, YouTube, Facebook, does anyone know where the 2% number actually comes from? Because it was kind of just an arbitrary number that they pulled out of thin air. And if you really study inflation, the normal inflation that we have seen, if you go back like 30 years, is about 3.2%. I remember that when I was a financial advisor. That's the number we always used, between 3.2 and, if we were in a heightened, it was like 4. I mean, we went way above that here, but we were in hyperinflation. And now we're coming back down, but I just don't get this 2% number. And I don't understand where they came up with that, because that's going to be a hard number to hit. And as you can see, the raising of the rates has worked. It's brought the inflation down, but we're still a long way away from 2%. So what does the Fed got to do to get us to 2%? And to be honest with you, you know what I think it is, Stephen? It's the employment numbers. It's the employment numbers, which are reflected in today's news, folks. Right? Headline news. I'll read this to you. And Stephen, if you want to post it, U.S. job growth slowed sharply to 177,000 in August, below expectations. But see, like, that doesn't tell the whole truth. What you really got to look at is you got to go in and look at what they were projecting, what they were hoping for. So remember, I said it's 177,000. That's the new jobs that were created. By sheer numbers, you would look at that and be like, compared to what? Well, let's look at the compared to what. If you look at the revised total, and you notice how there's always a revised total? Stephen, isn't it funny how there's always like the number they deliver and then there's a revision? And that's what this economist is saying. The revised numbers are always different than the actual projected numbers. But the revised totals, this is lazy cash, if anyone has not yet met the pretty famous lazy cash. He never misses a WTF. So anyway, back to it. The revised total of 371,000 that were added in July. The economists surveyed by Dow Jones were expecting 200,000 jobs to be added in August, which they came in only at 177,000, as Stephen's showing you there right on the screen. So I don't know. Let's just take a second and kind of unpack this, Stephen. What are your thoughts on the job numbers that just came out and the new jobs being created? I mean, is it truly showing that the Fed's actions of unwinding the balance sheet, making money more difficult, and making money way more expensive, is it working?
Well, no, I think the jobs numbers are very skewed to begin with, just the way that they're reported, and due to everything that happened with COVID, and so many jobs were lost and now they're coming back. I mean, so all these huge jobs numbers we've seen, is a result of a lot of that. But on top of that, if you look in the real world and what's really happening with jobs, is a lot of these jobs are people taking second jobs or taking other jobs that were no longer available and they're being forced to move. And so, some of these high job numbers we've had, I don't think in the real world have really been as strong as they're made out to be. But we've been talking about it now for probably a year now, Chris. But, one of the things that has kept the economy up is the fact that the jobs numbers have been represented so strong. And that's one of the little pieces that's been holding everything up. But now that if we start to see that fall, it's going to be a real quick unwinding of everything that's going on. So, how that translates into inflation. I mean, they're still talking right now about more hikes coming, interest rate hikes coming. And so at some point, if everything crashes, do they go back to zero? Then that just drives inflation again. So we're stuck in this spiral right now. And it's, they talk about soft landings, and there's not a lot of news pointing to it being any positive coming out here anytime soon. I think it's going to get very worse before it gets better.
Yeah, I mean, from what I've seen, I mean, the majority of the economists coming out that were even thinking that maybe we could have a soft landing, they have vanished. I don't think there's any economist out there right now thinking that the Fed's gonna pull off a soft landing at this point. I mean, none of the data shows that. If you look at the inverted yield curve and how inverted we are, and just folks, I know this is kind of weird topics and things. I just want to explain it. It's very easy to understand. So the inverted yield curve, what that basically means is if you buy a 2-year treasury bond, it pays you more than buying a 30-year treasury, which makes no sense, because think about that, right? You buy a 30-year bond, and that bond matures in 30 years from today, which, just because of the duration, the length of time of that bond, you would think that would pay the most. And normally it would, significantly more than a short-term or short duration bond like a 2-year. But right now, you get paid way more. I think it's almost 1%, or, it varies every day, but it was about 1% more that you would get paid on a 2-year bond over a 30-year bond. And you could even go down the scale. You could even go to like T-bills. You could go to 6-month T-bills, pay more than a 2-year. That is wacky, folks, completely wacky. And what you got to understand is, if you go back in history, every single time we've had an inverted yield curve, it has always resulted in a recession every time. Okay. It always signaled a recession. So we're deeply inverted, and we've been inverted. My gosh, how long have we been talking about that? I remember one of our 3-day money school essentials back last year, might even been the year before we first inverted. I'd have to look at the dates on that. So we've been inverted for at least a year. It's kind of like Maverick, in the first Top Gun, he's like, we were inverted. You guys, you remember that? Steven, you remember that movie Top Gun?
Oh yeah.
So anyway, but kind of useless. But let's go to one other thing. I think one other thing that you can look at for seeing where the economy is headed is not just the fact that new job creation is missing estimates. This is the first one they've missed, but also GDP growth. And I'm a little under the weather, folks, so bear with me if I can't get the words out today. GDP growth is actually down as well, right here. So stock futures slip with GDP and ADP jobs data ahead. So you got two negatives coming out today. You got the new jobs being created, missing the estimate of 200,000 by quite a bit. And then you got GDP growth slipping and starting to slow way down. No surprise there. Wake up, the economy is slowing down. And now you're finally starting to see the impact in the numbers.
And of course, the stock market's up 117 points this morning.
Of course it is. Now, folks, can I ask a question? And I want to get to some of the comments that are coming in after this. Can anyone tell me why the stock market has been going up, but all the news that we talk about, all the news you folks see, whether it's Yahoo Finance or CNBC or any place you follow, the news is not good? All right. So let's hear it. Why? Anyone? No one knows? This should be an easy one. This is kind of like that multiple point or multiple choice question that everybody gets right on the test. It's that giveaway. Nobody knows? I'm looking through. Come on. Instagram's got to have somebody that knows the reason for this. Let's see. We changed how Brandon said we're not, the reason we're not in a recession is because they changed how it's defined. Love that. New dumb money. Let's see. I'm just seeing if we got anybody that's got the right answer here. Trump's. Oh, you're right. Steve McCarthy said it's Trump's fault. That's funny. Now I know Steve, is not actually. We'll skip that for a second. But well, here's the reason why. There are 7 stocks in the S&P 500. That is, and just so you all know, and sometimes I gotta get real simple with this stuff, like 3rd grade level. The S&P 500 is the Standard & Poor's 500 stocks. So the 500 stands for 500 stocks. The Dow Jones is 100 stocks. So I want you to just for a second just rationalize and think about this. Both of those indexes, the Dow Jones and the S&P 500, are being held up, totally held up by 7 stocks. Out of 500, 7 of them are the reason the indexes are positive. And then when you dive deeper into that and you look at which stocks those are, a lot of those 7 stocks are being propped up and held up by speculation. Any surprise there? Stephen, was there any surprise that speculation is the reason that those stocks are high? Speculation of what? AI.
Yeah, it's the only. I mean, it's the only answer is speculation, because there's not a lot of basis on fundamentals by any means.
Yeah, no, it's definitely not fundamentals. And we got some folks coming in here on Instagram. A bunch of good comments coming in. But I do want to come over here to TikTok real quick. It's just user and a whole bunch of numbers. They said when I was referring to the 2%, where it came from, this person said 2% so that the companies don't give higher raises. I don't think that's the reason, but you know what? There could be some truth to that, because if companies continue to give their employees raises because they have to, because inflation is high, or because Social Security, has to get increased because it's adjusted for inflation, people make more money, which means they spend more money. I'm trying to think, is it Sutton's Law, or there's one of the laws, Parkinson's Law. Anyway, I can't remember to verbatim recite it, but as somebody makes more money, they spend more money. Once a luxury hat is now a necessity. I think that's the right way to say it. A luxury, once a luxury now had is now a necessity. So as we make more money, we get used to that level of income and we spend up to our income. Think about it. I mean, that's what people do. So if companies are giving raises, which they certainly were during the height of the inflation, people have more money to spend. So the Fed could have come up with 2%, because they want to make sure that companies don't give raises, because at 2%, that's a pretty modest growth and that's a pretty modest inflation. So therefore, yeah, maybe that could be it. I'm not going to say that that's definitely the reason, but there's some logic behind that. And then another person said, what bills have the House Republicans? So let's change what this person's asking. What bills, period, have any politicians passed to battle inflation? And they said, name one. So they're saying, what bills have the House Republicans passed to battle inflation? So there has been a bill that was passed, quote unquote, to battle inflation. It was the Inflation Protection Act. Stephen, the Inflation Protection Act, you remember when the Democrats proposed that bill to fight inflation? So now I'm assuming that this person is just saying, see, what bill have the Republicans ever passed to battle inflation? Because the Democrats did pass a bill to battle inflation. First and foremost, I got to ask, have you read the bill? Have you read the Inflation Protection Act? Or better yet, forget about reading it, because it's too long to read. Have you looked at any of the attorneys or economists that actually have read that? Because I have. There's not one freaking thing in the Inflation Protection Act. They just passed it because of the name. There's not one damn thing in that bill that actually does anything for inflation. And a matter of fact, the government really has nothing to do with inflation. It's all the Fed, because the Fed controls monetary policy. So sometimes, and I don't know whether they're saying that in a good or a bad way, but you could spin it both ways. So somebody just said,
inflation is driven through spending, and the Inflation Reduction Act completely goes against that by spending more money. It's one of the largest bills ever passed for spending. And so the more spending in the economy drives inflation. So if you want to look at bills that are passed, look for ones that are cutting spending, look at ones that are trying to reduce deficits. And that's what helps with inflation. So you can go do that research on your own.
Yeah, I think that's great. And I think over here, Mona Hellman, I think it is, on TikTok, said the bill wasn't going to get GOP support in the Senate. So he said it was a stunt. I mean, they changed the name of it because at that time we were at a very heightened level of inflation, and that's what was in the media every day. So they said, oh, let's just change the name of the green, the Green Deal, or the green, what was that called? The Green New Deal or something, New Green, whatever. I don't even care. But they changed the name of it. That's all they did. They said, oh, this is the Inflation Protection Act. And all that Inflation Protection Act did is print more money, to spend more money, to push this green initiative. And my mother was just buying a car the other day because her lease was up. Well, she was leasing a car. And like, I could not believe, Stephen, have you looked at like just basic new cars? Have you looked at it? My mom's lease on an Equinox, because she loves Equinoxes, right now is like $289. Do you know how much do you think a new lease on the exact same vehicle is 3 years later?
Oh, I'm sure it's higher, but I couldn't.
Almost double. It's almost
Wow.
double. So just think about that. It's almost double. How in the world are people affording to live right now? I mean, groceries are crazy. God forbid you want to buy organic groceries. Car prices are through the roof. An Equinox is $32,000 car. I looked at every SUV on the market, and the cheapest one that I could find was the Chevy Trax. It's a two-wheel drive, which you don't want a two-wheel drive here in Buffalo, but it was like $23,000. I mean, I had a like a slap of reality. I guess sometimes I feel like I'm living under a rock. You know, when I saw that, I'm just like, good Lord. And people are lining up for these things. They really are. It's just insanity. And,
What?
you know, I asked Brian, the salesman, I said, you know, so what the hell is going on here? He said, well, the cost of everything are going up. There's still, you know, a lot of people that want these. I mean, before these things roll off the trailer, there's a list of people that want them. And I said, yeah, but the pricing, like, how can you justify double? And he said, well, interest rates, you know, on these leases, does anyone ever like look at the interest rate on your lease? Did you realize your lease has a baked in interest rate? And it's all dependent on the car, your credit score, and a whole bunch of factors. But do you know the interest rate on the leases right now are 8 to 9%? Think about that. 8 to 9 bloody percent. It's freaking crazy.
Look at this. So looking for a new car, there's only one vehicle left in the United States that's now selling for under
That's what's electric.
and it's a Mitsubishi. I didn't even know Mitsubishi still made vehicles.
I didn't either. Is it an electric car or is it a gas-powered car?
No, it's gas.
You see, my mother could have leased an electric car and got a bunch of incentives, and that electric car would have been significantly cheaper, almost $50 a month cheaper. But she didn't want an electric car because here in Buffalo, I mean, last year we had a blizzard and a lot of the vehicles stranded on the thruway. And unfortunately, I hate to say this, but a lot of people died during that blizzard. And people that had electric cars, like they couldn't get one. I mean, sorry, the batteries go dead in the cold. It's just a fact of the matter. I mean, and we're going to push this green thing. And I asked the salesman, I said, you know, so if they're pushing this big green initiative and they're making, you know, electric cars so much cheaper, what are you hearing from your customers? And he says they don't want electric cars. They're scared of it. Like there's all sorts of issues. He said we had somebody just trade in an electric car. They only had it like 3 months, is because every time they went to charge it, the chargers didn't work, you know, or it was a 20-minute wait to charge the car. He said, forget that. I don't want that. And he said the battery, he said people are saying that even though the battery, you know, of the car says, and I'm not talking Teslas, but just GMs and other cars, the battery life on the cars is significantly diminished in the winter. So that particular example, they had an electric car, which said it was going to get, I don't know, let's just hypothetically say 300 miles on a charge. They got about half in the winter. So I don't know about, Stephen, I know you don't know much about winter being in Florida, but here in Buffalo, it gets pretty freaking cold. So if you got a car that's supposed to go 300 miles, and then as soon as winter hits, you know, and we see 20 below or 20 degrees and below, like now all of a sudden you can only go 150 miles. Like, I don't know. That just doesn't seem like a good, it just doesn't seem like a really sustainable model.
The average new car is just about $48,000, 25% more than before the pandemic struck 3 years ago.
And how much did you say the average car was?
Just above $48,000.
$48,000. So the lease on a $48,000 car is going to be in the probably $600-700 range. Like, do you remember, Stephen? It seems like it was yesterday. My God, you could go get a BMW, like a pimp BMW or Mercedes for $700 a month. Do you remember those days? Because it was only a couple of years ago.
Yeah, my wife leased a BMW. It was probably 7 or 8 years ago now, but I mean, it was $350 a month.
Yeah, I remember having a 3 Series TDI BMW. It was a sweet little car, great on gas. And my lease payment on that car was $350. That was the M package. You know, Steve McCarthy here came in from Facebook. He said the average car lease is $700 to $1,000 a month. I hate to say this, and folks, don't get mad at Stephen or I, but we are completely oblivious to what's going on in the real world of like taking loans and cars and this, because we use our banking system. We use our private banking system, the infinite banking concept. We get all the money back for all the cars we ever buy, drive, and own. I know none of you would want to know anything about that, but I'm just saying, like, we literally get all the money back for every car we ever buy, drive, and own. So like all this stuff about like lease payments, like it hit me hard yesterday when I was at the dealership trying to help my mom. I felt helpless. I felt like I was there with my mom and there was not a damn thing I could do to help my mom. I tried negotiating the price. I tried negotiating the rate. Dude, there is no more negotiation on cars. And I know Brian, he's been getting cars for my family he's been in the business well over 20 years. I don't even know how long. And he's always helped negotiate cars. This is the very first time. And he literally stared me in the eye and he said, Chris, there's no way we can negotiate anything. I was just like, all right, my mom's lease that she's handing in, she's got an Equinox that she's trading in. I'm like, the car's definitely got to have equity. I mean, I looked, she owes $17,000 and she's got like 27,000 miles on it. I'm like, this car's got to be worth more than 17,000. They appraised it. Where do you think it came in? Under 17,000. But I thought for sure she'd have equity in that. So it's just a game, folks. If you're looking to buy a new car and you're not buying it the way that we teach, where you get all the money back, like, I feel for you. I truly do. More now today than I ever have before, because I just went through it and I left that dealership feeling freaking defeated. But I mean, I know we're here to talk about the news. So Stephen, what else do we got in the news?
Well, one thing we could do, if anybody does want to learn how to do that, we could always teach that at 1:00 today on Wealth Webinar.
We could. And I've got some real life examples of some things that I'm doing right now that I'd love to talk about and show you that I'm doing for, how you can make an arbitrage, how you can make a spread on things that probably exist in your life right now. It's super easy. There's nothing hard about it.
Let's do it. Join us at 1:00 today. So go to chrisnaugle.com and you'll see where it says Wealth Webinar Wednesday. You click register for that. We'll actually give you a few free digital ebooks you can get started reading and checking out. And then join us at 1:00 today and we'll get into that with you. It's going to be good.
Yeah. Kath over here on YouTube said, I regret not getting a hybrid. She just said gas is back over $5 a gallon. But here's the question I have for Kath is, I know, when you charge your car, right over here, we have a Tesla charging station. Now, I don't own a Tesla. I love, Elon, and I think a lot of the things he's done, but I don't know what it costs to charge a car. Like, I don't know how they do that, but what is it? Is it like 20 or 30 bucks for a charge? Does anyone know what it costs to do a charge? I mean, anyone on TikTok, does anyone have an electric car? Like, what does it cost to charge your car? Again, I drive a gas guzzling V8, so I have no clue what it costs. But, I'm just kind of waiting for someone to chime in and tell me what it costs to charge a car here. I know someone on here's got an electric car. Oh, hybrids don't need charging. Actually, great point. But let's stick with the agenda, if you will, and try to figure out what it costs to charge a car. What I was trying to say is, yeah, Drew would know this because he has a great hybrid. He's got a Lexus hybrid. That thing's pretty badass. It's like 40 miles to the gallon. But I think it's like 20 or 30 bucks to charge a car from what I remember. How long do you think, as more and more people go full electric, not hybrid, but full electric, how long do you think it'll be before the price to charge your car goes up to meet the cost of gas? As less people own gas cars, as more people own electric cars, do you not think that the electric companies or the government or whoever's behind it pushes the price of electric up? They're going to. So, I always think it's an illusion to complain about higher gas prices, because soon electric prices will rise to meet gas prices. Mark my words, I bet you any money that will happen. As more demand comes on, as they have to build more infrastructure and more power plants, which, just so you all know, the solar powered and wind power, like, it helps, but it will never support the infrastructure needs. So Stephen, do you know how they create energy? How do they create electric? Outside of solar and maybe water power and wind power, how do they create the majority of the power that runs through the grid?
Power plants, coal.
Yeah. Coal. Oh, coal's nice and clean to burn, isn't it? Anyway, let's get off that topic. What else do we got in the news here?
Well, they're mentioning somebody mentioning the Orange Man. So just a little bit of news that came out this last week was everyone's Favorite guy. Let me see if I can pull this up here. What happened to
Well,
it?
while you're pulling that up, I love this comment that just came in. Max and Creek on TikTok said, "Does this guy just say nonsense words? Sometimes I ramble. Sometimes it is nonsense, but whatever. If you don't like it, see you later, Max and Creek."
Yeah.
Is this last time I checked, Stephen? This is not the Max and Creek show, right? This is what the app. So we can
It's
rant.
just funny why somebody would join something and then like take the time to say they don't like it. Like, wouldn't it be faster just to move on? It's so bizarre to me. But so Donald Trump was arrested and his mugshot was taken this last Wednesday, Thursday night, whenever it was. And that quickly went around the world as probably one of the most famous mugshots that will probably ever be taken in the history of the United States. And that's, putting it up against some pretty cool ones in the past. It was kind of neat to see all those floating around, but it seems like this guy, the more trouble he gets in, the more people love him. He raised millions and millions of dollars from this mugshot. And this is a post he made on Twitter. So he's been off Twitter since Twitter kicked him off, back whenever that was in 2020. And then Elon Musk, started, converted Twitter to X now and let Trump back on. But Trump, a lot of people say he's got a lot of vested interest in Truth Social, which I've never been on, but it's another social media kind of type platform. And so Donald Trump finally came back this last Thursday and posted this mugshot on X for the first time in many years. And so it's just kind of fun to watch. It's kind of fun to see. And it's pretty interesting. They set one of his trial dates for the day before Super Tuesday, the primaries, one of the most, largest primary days in the Republican primaries. And so some of the stuff happening right now is really interesting. And, there's pasts that show Trump sitting in jail and being the president of the United States. So we're in a crazy world right now when you have this guy and Joe Biden as the two front runners for the two major parties in the United States. I don't even know what to think of it. And so when you see just all the insaneness of what we call this country right now and everything going on, it's just, to me, it's why it's more important than ever to focus on what you can control, because all this stuff is so out of your hands. So focus on controlling your money, controlling your investments, controlling your life, control your health, take care of your family. In turn, all of that will take care of your family. And that's all you can do. And that's why I love what we do, Chris, is because we joke around and we have fun about some of this stuff in the economy and what the Federal Reserve is doing and talk a little trash. But at the end of the day, it's so important, though, because even though you can't control if the stock market crashes or if the housing market bubble pops, we can't control that, but we can be ready for it. If we prepare ourselves right now, we can have our finances ready. We can have our lives in order. We can have our jobs, our businesses prepared for what's coming. So just more important than ever when you see stuff like that, just, running at the front of the news and just the fact that, I was watching a little bit, Jerome Powell, who's the, Federal Reserve chair. They're up in, where were they? In Jackson Hole, Wyoming this week, Chris. That's where their meetings were. And it's just wild for me to watch. Like, the entire country is just watching this little group of people in Jackson Hole, Wyoming, basically just hanging on every word they say to decide which way our economy is going to go and what's going to happen with this country. Like, how did this little group of central bankers get so much power and so much control? It's just,
I have the answer.
Unbelievable.
Read The Creature from Jekyll Island by Edward Griffin, and that'll tell you exactly how they got so much power. It happened in 1913, and it happened.
How are we okay with this?
Jekyll Island Club.
Yeah, it's just
how are they? Because just like anything else, like our voice, our vote doesn't really matter. They pushed it through. If you read The Creature from Jekyll Island, you'll see how one of maybe two people literally navigated the entire thing through. I mean, none other than just bribing people and got it through. Like, how do you think the Inflation Protection Act made it through both sides? Well, probably bribes, promises of one thing, one side getting what they want, and then it gets pushed through. So how did this small group of central bankers get so much control? Well, it wasn't because we gave them control, as they would say, well, you voted them in. No. there's a little bit more to it. You got to read The Creature from Jekyll Island to understand that.
It's just wild, man. Just unelected. I don't even know what you call them. They control every aspect of what's happening with the economy. It's just wild. So, anyways, flipping over. Another interesting. If we want to change topics a little bit to housing and real estate.
Yeah, before we get to housing, let me just hit on one thing that Drew and also Be the Goat came in on. That little stunt, that little mugshot raised Trump $7 million, and then I kind of like what was said over here by Be the Goat. He said, if he can raise $7 million selling Chinese merchandise, I guess Bidenomics is working. Pretty interesting take on it.
That's the stupidest take I've ever heard in my life.
I said interesting. I did. You can say stupid, interesting. And I think what he's referencing is selling T-shirts, and most of the T-shirts that you see today are made in China. That's probably what he's getting at. Yeah. So who knows? There's a lot of interesting, as you might call them, stupid comments that come in on this show, and that's what makes it so fun. No way they were just going hunting, right? Oh yeah. No way they were just going hunting. So let's move on to real estate, and I think there's a lot of places we can start there, but let me just start with one article, and then I'll let you take over from here. Stocks are posed to tumble, and many Americans are prisoners in their own homes after mortgage rates soared. Top economist David Rosenberg said. I'll open it with that. What do you got?
For housing?
Yeah.
So just a conversation, I've talked to I talked to a lot of clients throughout the week, and something I've been hearing a lot is anytime I talk with mortgage brokers, just how their income's been cut in half, how they're really struggling right now. I know a lot of realtors right now are out there struggling. So it's just interesting to see how the overall economy affects so many jobs on a lower level. But one interesting article I saw recently was just how many investors. It talks about investors. So is this the beginning of the end? This was from last year, but just talks a little bit. And there's another one that just came out that shows this trend continuing to drop. But it just shows this was starting in 2019. And this is showing home purchases made by investors. And I know we work a lot with investors. So I just want to get your take on this. So you kind of see, I'd have to go back to before 2019 and look what it looks like. But, we kind of see going into COVID, around 18%, it looks like, of home prices. Then obviously COVID came, everybody got spooked. After we saw COVID, kind of the housing market. And then, as we all know, the market shot up like crazy. And I think that's when a lot of investors started jumping on the bandwagon. And the one thing I thought was interesting, though, is I wonder if, are investors kind of keeping the market propped up? And were they keeping the housing prices high and really driving a lot of that demand we saw? And then at one point, does that cut back where it doesn't make sense for investors to buy? So they start getting out of the market, and then that allows prices to start coming back down. I don't know. Just thought this was an interesting little graph that I saw here.
That's a big fall off there. And I think you're right. I think, a lot of us, especially in the real estate industry, we knew that, the institutions were buying up neighborhoods and housing and driving pricing up. I mean, it was, the iBuyers, is what we used to call them. We've done lots and lots of videos on them, but they, that was, who are the iBuyers? I mean, they came under many names, shapes, and sizes, but who were they really? It was really the government. All that printed money, 5.1 trillion, made its way into the hands of institutions. And those institutions were able, because many of them, like BlackRock and Blackstone, double down as a bank so they can play into this whole fractional reserve banking. But anyway, they had a lot of free money to go out there and just spend. And what they do? They bought, instead of buying Wall Street, which is the industry they're in, they bought Main Street. I mean, it's probably not a smart. It's probably not
updated one. So this goes right through June of 2023. So you can see it came back and kind of holding steady here. But as rates are rising, one of the things why this percent is so high is, home owners have a tough time buying a house, mortgaging, with the high rates. And so a lot of times investors come in and purchase cash, even if it's private money, it's kind of considered cash a lot of times. So, it makes you wonder, what's going to happen with this as these investors start to slow.
Yeah. Yeah, it's I think the pricing's been propped up, and you see it in the media, and it's demand, demand, demand. But the demand is in the first-time home buyers, and the higher interest rates go, the less and less of a reality it is that first-time home buyers and millennials can actually afford the housing stock there is. On Private Money Club, we've got a bunch of developers on there, but there's this one gentleman who was at Money Tank, the Private Money Club Money Tank event. And I got talking to him, and he's a small developer, but what he's found a way to do is in parts of Florida, your neck of the woods, but not the populated areas. He's building homes, but he's building budget-oriented, price-oriented homes that he is able to retail profitably between about $400,000 and $500,000. And these are really nice homes, 3-bedroom, 3-car garages, really nice. I mean, there's no frills or thrills. I mean, it's pretty basic, there's not like crazy upgrades in it, but I mean, like at that, I mean, I hate to say that 400,000 to 500,000 is the sweet spot, but it really is. I mean, that's just what a first-time home buyer can barely afford, and I go through this a lot because I've been selling off a bunch of my properties, and we had 2 properties recently close. Both sold way under market because we had agreements with the lease in the lease that they could buy the price, and we just honored it, even though we didn't have to. We could have been assholes, but we just said, So the one house we sold for $225. Okay, so $225. The house is probably worth over $300, but we sold it for $225 to a family member. Now let me preface: this family member and his girlfriend both work full time. He works for the town, and she works at a veterinarian clinic. So not that those are high paying jobs, but that's kind of like a starter job, right? Like, just started at the town, so I don't know what the town pays, 45, 50 grand. And in the veterinarian clinic, maybe 30, whatever she makes. But you can see, like, this is pretty typical for a first-time home buyer. They barely can afford a $225,000 house by the numbers. I mean, they barely qualified for the FHA. And now, if that's the reality, we're talking about a $225,000 house here in Buffalo they could have never found on their own because we helped them out and sold them the house under value. So how in the freaking world are families affording housing stock at $400,000 to $500,000? Please explain that. I don't even get it because it doesn't make logical sense. So there's got to be something else going on behind the scenes. Maybe some of these folks actually saved some money. Maybe their parents are helping them, because the one thing keeping middle class afloat right now, which I think is an illusion, is equity in their homes. So a lot of American families have equity in their homes. So parents are helping a lot of their children out, and many of them are doing it with the equity that they have in their homes from this last little crazy run up in the price. What are your thoughts on that, Stephen? And I'd love to ask the audience what their thoughts are on that.
No, I was going to say, I'd like to hear what people have to say too, just about their areas. Like, what are they seeing in the housing market? Like, are they seeing, prices coming down? Are they seeing people out there looking still? Is it a strong demand? I mean, I know where I am here in South Florida, it's still pretty high demand. Not a lot on the market really, though. It's not a lot out there. And I think that's holding the demand high and keeping prices up there. So, we haven't really seen much relief, so to say, for many home buyers. But I'd like to see around the country, because I know South Florida is a little bit of an anomaly.
Yeah, and one of the comments came in from Deplorable Millennial. So just by the sheer name of their username, I want to listen. It says, I think it's not first-time home buyers that are buying homes sold. He said it's basically they're using money from one house being sold to buy another. But I also got to question that. Like, why would the average person sell, unless they're downsizing, moving to a different area, or there's some weird, obscure reason? But why would somebody that's got a mortgage on a house at 3% sell their house, even though they can sell it at the market high, to then move into another house at the market high when their interest rate is going to be above 7%? Like, that right there, part of that creates the demand. They're not, but like, why would they? But I think right.
Yeah, I've known a couple of people that have done that, and they've taken different paths. So one, I know that their house went from maybe 250, 300. They sold it for 860, 870, right in there. So they made a bunch of money on it, and they're renting for a year. They decided to rent and start looking at possibly building something going that route. But the problem with that, though, is that they're paying astronomical money to rent. Like, rents are very high right now too. So if you go back to the old, rent first buy, and at a cost basis, even at higher rates right now, it can still make sense to buy. And if, maybe it's not your forever home, or if it is, I know a lot of people are buying now and they're just banking on the fact that they can refinance in a couple of years, banking that rates are going to come back down, which, the
Who
Fed might
knows?
have no other thing to do but then lower rates again here soon enough if everything crashes. So, people are banking different ways: rent until rates come back down, or just buy and plan on refinancing. And I see it happen a lot.
So there's some great comments coming in on this. I mean, we struck a little nerve here on this housing thing. So TCH, looks like RMB said they're not affording homes. In other words, first time home buyers aren't affording homes, which then plays into a deplorable millennial said rent is outrageous. They are buying homes because it's better for them. So kind of right along with what you just said, Stephen. And then another person said, I bought a 1,200 square foot condo so my kid can move into it. So there you go. That's kind of right on line with what we were saying about parents are helping their children. I mean, whether it's with equity or just the increased income, you can work. You have to work 3 jobs now to make ends meet. Like talking about our family member, works for the town. His girlfriend, works for the veterinarian, and I know he does a bunch of side jobs to be able to afford a $225,000 house. Think about that. Like, that's crazy. Like, people are working 3 jobs. But I guess, hey, kudos to those that are doing that, because that's the hustle that I like to see. It becomes the house payment on the inflated. And a lot of times people are looking at it, do I rent or do I buy? I mean, sometimes I tell people, and I don't know if this is good or bad advice, but I tell people just rent, like, until pricing comes down on the housing, because I really do feel houses are going to come down, like the price is going to come down. So I tell people to rent, but you're right, rents are outrageous. But if you lock yourself into a house, I feel like unless it's like a house you really love and can afford and want, like if you buy a house, you're buying it at the market high. You're buying it at a really high interest rate. Although, yes, in the future, maybe you can refinance lower, which I'm sure that'll happen. But when you buy a house, folks, please learn what the velocity of money is and how the bank wins and you don't. Every payment you make on your home mortgage, very little of that in the first 5 to 7 years is going toward your principal. Very little, like maybe 15%, if you're lucky, is going toward principal. So are you really getting ahead buying a home versus renting a home? And I would say the answer is no, because if you buy a home and the price of the home comes down, you're pretty much underwater, which is what that article said. You get stuck in the home, where if you rent, you're not stuck. You can always buy a home when pricing comes down, interest rates come down, things meet your needs. But I just think that that's a dangerous place we're in right now. People are rushing to buy homes that they can't afford when, we see job numbers are starting to change. The economy is starting to weaken. Some people are going to be unemployed. Like, there's a lot of fear here. Yeah, there you go. Look at that.
Housing affordability index.
Is it
falling through the floor right now?
Holy shit. I've never seen that chart. That's wild. That is freaking wild. And then let me come over here. We got some, and we are going to hit China as a wrap up, because I got an interesting thing on China. Steve McCarthy was asking about that. But Lynn Green said they aren't, again, kind of rivaling what other people were saying. My daughter and her husband are trying to buy, and you are correct. We took some equity out for when they qualify to help them. So bingo. I mean, people are using the equity, and their parents are using the equity in their homes to then help their children get into the next home. Noah Harris, who's on our private money club team, he's the master of disaster when it comes to coaching and private money. He said, everything you're saying, we are seeing. High demand for nice products, low demand if the house needs work or is outdated. If that's the case, the house will sit. We are getting ready to double our volume and grow. So people want fully renovated homes because they number one, they're overpaying for a house. So because they're doing that, they don't have the money to renovate the house. So the HGTV, buy the house and renovate it, like, people just don't have the means to do that because the house costs too much in the beginning. So that's, anything you got to say about what Noah put up there, Stephen?
No, I mean, no, they're in the thick of it every single day. Noah and Christy, his wife, are out there buying and selling real estate. They're in Columbia, South Carolina market. So, Columbia has had a lot of people moving there from up north. They have mild weather, good people there, good schools. And so it's become a very popular place. And so kind of what you see there is a good metric, in my opinion, to kind of what's going on in the country. So, and I hear that same kind of thing from a lot of people all over the place. So no, it's definitely spot on right there. And just to give you a little idea on kind of where we're at right now, the average home price is, according to National Association of Realtors, but just over $400,000. Salary required to purchase your average home right now is just over $165,000. That affordability index is the lowest it's ever been on record. Average payments right now are $2,300. Just to put that in comparison, the average payment pre-COVID was $900 a month. Right now we're at $2,300 a month. So things have just gotten really, really wild, out of control.
I mean, everybody listening to this, we got a lot of people that follow us on this show. I mean, where do you think all this ends? Like, just listen to what we're saying. Yes, we go on some rants, but like, just hear what we're just in the real estate side. Where do you think all this ends? Like, it ends one place. So for anybody that thinks that this whole thing's not going to crash and burn and go down, and I can't tell when that's going to happen, like, you're delusional. Like, there's nowhere else for it to go because nothing makes bloody sense. None of it makes sense. Now, Katrina Dawson over here on TikTok said something that's really smart, and you're seeing a lot of this. It's perfectly in line. She said, I decided to invest in the current home that we have and update it rather than to lose the interest rate. Exactly why people are doing that. Like, why buy a new house when you can just invest in your current house and keep your interest rate? Like, that's where part of the demand problem comes in, because people don't want to sell their house. And to Katrina's comment there, like, why would she? Just renovate it. And over here,
there's another good one. Our neighbors bought, from Shadow on Facebook, our neighbors bought a new construction home for $550,000. There's at least 6 adults living there, 4-bedroom home. Multi-generational living is the only way to make it work for a lot of people.
And, that goes back to, you could almost take that back to like the 30s, 40s, and 50s. There was like multi-generational families, that everybody lived in the same home in relatively small homes. I mean, are we going to see those days again? It seems that way. But who knows? I mean, you never fight the Fed, because as we enter into a recession, which, folks, we will, as we enter a recession, you're going to start to see things change. The Fed, I don't know. Some people will say the Fed will hold interest rates high, and I can see the reasoning for that. But, if you look at history, the Fed typically reduces interest rates when you go into a recession. So it's anyone's gamble on that one. And the timing of it all is just a whole nother, you just can't fight the Fed and you can't time the markets. So let's, Stephen, let's take the final couple minutes we have on the show and let's hit China. We're going to go across the world real quick, and we're going to talk about China. Now, some of you are like, why are we talking about China? We live in the U.S. Well, because it's a world economy, and China, is one of the fastest growing economies in the world, or was. But I want to show you that China could be the reason the entire house of cards crumbles. Not so much the U.S. We got issues here in this country, but China's got massive, massive problems. So not only can they not support their growth in the future because of their demographics, they have an aging population, and it's creating massive problems. We hit that last week on the show. But the biggest problem in China is, if you look at their GDP growth and you dissect it, 30% of their gross domestic product is real estate. So then let me beg to ask you all what your thoughts are. When the news hit, I think last week or maybe the week before, when Evergrande went bankrupt. Evergrande was I believe, second largest home developer or real estate developer in China. They're done. They're bankrupt. They're seeking bankruptcy in the United States, of all places. Now, don't get me started as to why that is. But see, that's not the real problem. I want to go back. 30% of China's gross domestic product is real estate. Brings me to this article. Stephen, this is Yahoo Finance if you want to pull it up. There's a little known company, not known as well as Evergrande, because Evergrande's been in the news so much, but there's another home builder. You may hear of them. They go by the name of Country Garden. They are the largest real estate builder and developer in China, bar none. Headline news: troubled Chinese home builder Country Garden is rushing to raise cash to avoid default. Holy shit. Okay, so Country Garden is raising funds to avoid default as the troubled real estate giant battles a liquidity crisis, which some fear could spread to China's wider economy and even spill over abroad. How many of you have 401ks? If I were to ask you to raise your hand, 98% of you will raise your hand. How many of you in your 401ks invest in something that has the word emerging markets or in international? I bet you 90% of you raise your hand. And then the rest of you are just like, I don't even know what I'm investing in. Exactly my point. You probably have exposure to Country Garden, because if you're investing in an international mutual fund or ETF or anything, you got to understand it's a world economy. Country Garden, the largest real estate developer in China, has exposure to the funds you're investing in your 401k. Mark my words, they're in there. So that's where it says could even spill over or abroad. You all, like, a lot of people don't realize that, like, just because something's falling apart in China, like, you're like, oh, it's in China, it's not going to affect us. Yes, it will. It will affect all of us. It will affect the institutional investors. It will affect the 401k investors. It will affect all of you that have your American funds, Vanguard, Fidelity, T. Rowe Price funds, and be like, oh, I don't have to worry about Country Garden. They're in China. Yes, you do. You have exposure, and it will hurt. And it's talking here, they're planning to issue 350 million shares of their stock at 10 cents a piece to pay off loans it owes to creditors, according to the stock exchange filing. So the total value of these shares would be $270 million, which is nothing compared to the holdings that this company has. Let's see. On Monday, and this is just one project I want to make. On Monday, the company said its $100 billion project, 100 billion, do you hear that? $100 billion project in Malaysia, its largest overseas development, was operating normally, adding that its operation in the region was safe and stable. How many of you believe that? How many of you believe it's safe and stable when the company is rushing to raise capital just to keep itself afloat? Anyway, I didn't want to end on a bad note with China, but this is the reason you folks really need to get around the campfire and join us this afternoon at 1 p.m. to learn how you can take back control of your money. You can take back control of your money by being the bank. Like, a lot of people, like, we're like, I don't want to be the bank. Oh, that's a scam. You know what the scam is that you've been taught that you know everything. That's the biggest scam in the world, is when you think you know what you don't know. You all need to learn how to take back control, because, like, listen, just the couple things we hit here today should be a hint that it is time for you to take back control, because they're not looking out for you. Okay? Country Garden's not looking out for you. The government's not looking out for you. Fidelity, T. Rowe Price, Vanguard, all the big institutions, BlackRock, Blackstone, they're not looking out for you. They don't care about your money. The only person who should be a good steward of your money is you. So it's time for you to stop thinking you know what you don't know. It's time for you to start realizing that the problem isn't what you don't know, it's what you think you know. And then you will then have the mindset of saying, you know what? Maybe I could learn something new. Maybe it's time for me to learn something new. Maybe I do want to learn how to get all the money back for every car that I buy, drive, and own, because these lease prices are ridiculous. If you've ever even thought of any of those, then join us at 1 o'clock this afternoon, and that's Eastern. Go to chrisnaugle.com and register for the Wealth Webinar, and you'll get my books for free. 3 ebooks will be given to you for free just for registering. Like, what do you got to lose? Your time. That's it. And your ego. Because the reason you're not where you want to be in your life isn't because of your job, isn't because of someone else. It's because of your fucking ego is gotten in the way for you to learn something new. So drop the ego and start learning what you need to know to take back control of your money. Stephen, what else you got to say to wrap this thing up?
Just get ready, man. Get ready, because the data's all pointing to some major changes coming. And as you said, you got to be ready. I mean, just to kind of sum it up real fast, over the last 3-4 years, essentials are up 20%, while real disposable income is up 3%. So just, again, common sense tells us that's something that's tough to control. Savings built up during COVID from all that money that was pumped into the economy and passed out, all that COVID cash, as they called it, which drove that inflation to begin with. Now what we're facing is all that savings is gone. Credit is breaking over the $1 trillion mark. Credit usage has never been higher, record levels. The rates on that credit is increased to unmanageable levels. The average credit card right now is 23, 24%. The average loan outside of that's just in half, around 12%. A lot of interest being bled out right now when people are not making the money to keep up with everyday spending. So debt is out of control. The housing market is completely, as we talked about, high. People can't buy houses. It's kind of stuck in this limbo right now. If rates keep coming, watch out for that. And now we see consumer spending is coming down. And now we're seeing the last signs that we just reported that we started today off with the jobs are starting to go away. And that's the last shoe that's going to drop before everything starts to tumble. So be ready for it. Join us at 1 o'clock today to start preparing. And we're on this journey with you guys. We're here with you.
All right, folks. Thanks. That's the perfect wrap up. We'll see you at 1 o'clock this afternoon. Till then, get control of your money and we'll show you how.